as we know, this morning, the Federal Reserve gave us a wonderful discussion of the economy and did nothing. What the Fed said was the committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. In support of these goals, the committee decided to maintain the target range for the Fed funds rate at 5.25% to 5.5%. In question time, Jay Powell responded to, is there going to be a recession? And he said, well, with data this strong, it's really hard to believe there's going to be a US recession. And then a question probing him for forward guidance. And I've been fascinated how recently with central bankers, forward guidance is now so incredibly out of fashion. When Michelle Bullock last week was asked a question at a presentation that she was giving about where interest rates might go in the future, she said, I hope you're not asking me for forward guidance. And in the same way, Jay Powell here ran away from forward guidance when he was asked, doesn't the dot plot suggest there should be another rate hike? He said, well, the significance of the dot plot decays over time. We'll see another dot plot in December. So forward guidance is generally out of favour. But what he did say, and where the Fed is continuing to act, is where he says, in addition to not doing anything, in addition, the committee will continue reducing its holdings of Treasury securities and agency debt and mortgage-backed securities as previously announced in previously announced plans. So today I want to talk about quantitative tightening and where I think that's going, and point out that it's really quite real and it has major effects on the bond market. The level of holdings by the Fed back in September 2019 was $3.8 trillion. $1 trillion here, $1 trillion there. It's still a lot of money. But that built by $5 trillion by April 22 to $8.965 trillion. A dramatic increase in Fed buying of bonds. And the reason the Fed was buying those bonds was to keep bond yields low, precisely for that reason. And then in April 2022, the Fed decided to run off that holding of bonds by allowing them to mature. That's called passive QT. And they allowed them to mature and run off at the short end of the yield curve. And that was interrupted by a rebuilding of Fed assets to support Silicon Valley Bank and other things in the middle of the year. But the most recent available number is that level of Fed holdings has fallen from $8.96 trillion in April 22 to the most recent $7.9 trillion. So there's fully $1 trillion of debt that the Fed is allowed to go back into the market, which expands the amount that the Treasury has to hold. And we know that $7.9 trillion is, still $4 trillion higher than where they started back in 2019. So that's going to continue to put pressure on capital raising by the US Treasury of around about $1 trillion a year for at least the next 4 years, next 5 years. And where Treasury has been raising the money has been so far at the long end of the yield curve, because that's where rates are cheaper. And so that continues to put upward pressure on yields. In addition, the US Treasury also has to raise money to fund the US budget deficit. And the outlook for the US budget deficit as provided by the International Monetary Fund in their October outlook says that Treasury has a lot to do in raising funds already. In addition to that $1 trillion a year that the Fed is allowing to go back into the market. They've got a lot of work to do in raising money to support the budget deficit. Because in 2023, the year we're in, the IMF says that the US budget deficit was 8.2% of GDP. That means $2.2 trillion of additional bonds have to be sold by the Treasury. Next year, the budget deficit falls to 7.38% of GDP, according to the IMF. But still, that still means $2 trillion worth of bonds have to be sold by Treasury, in addition to the trillion that's run down by the Fed. In the following year, the US budget deficit continues to stabilise at about 7% of GDP, but that means in 25, $2.16 trillion worth of Treasury bonds, in addition to the billion from the Fed. And in 26, $2.2 trillion in addition to the billion from the Fed. And so it goes on. So what you've got is an outlook where there is enormous supply of bonds, and that pushes bond yields higher. Now, just so that you don't follow this presentation by looking for the sharpest razor in your bathroom cabinet, what I point out is that, that's very tight in terms of international liquidity and international trade, as long as the US dollar is getting stronger, and the US dollar is usually getting stronger when the US economy is growing strongly, as it is now. But next year, what happens is the US goes into a slower growth cycle, with that growth expected to be about 1% of GDP. We'll see the updated outlook from the Fed in December. And we'll probably stay around that 1% for quite a few years, and that means that you'll move from a period of a strengthening US dollar, in which this generates a very tight monetary policy, to a position where a lot of those bonds have to be financed by foreign buyers. That means the US dollar falls, and there's a flood of international liquidity flooding out into the international capital market. And that's prospective. That's going to continue for 4 or 5 years. And as it does, it generates a flood of increasing volume of international liquidity, and volumes of international liquidity of that size historically have generated major long-term commodity booms. So what we've got is a very tough period between now and the middle of next year, until the US economy slows down, because these high bond yields will generate a tight international circumstance. But as the US economy rolls over and the US dollar does with it, this will generate a flood of liquidity in the next long-term commodities boom. So stay away from that razor in your bathroom cabinet. You might find that by the time we get past the second half, into the second half of next year, everything is going to look much, much stronger.